All right, let's get started. So I want to do three things today. Work through the problem from last week. It's an important problem on the exam. It's also an important part of, it's somewhat of a mini papers 3 and 4 as well. So it helps you from both standpoints. Then we'll talk about anything related to the class or anything related to papers 3 and 4. And then we'll finish up with participation problem, although I'm not sure you'll be able to answer it until next Tuesday. So I'm going to give you a problem that won't be in the class video until next week. So I'll give it to you today just because we won't have a Zoom session next week. So let's look at that problem from last week. So I'm giving you all these numbers for paper 3. You've got to come up with all these numbers. So we got told they build houses, so that gives you some indication of the kind of firm that it is. So what we need here is a discount rate. And so to get a discount rate, we want to get the risk-free rate plus beta times the market risk premium. You don't know that premium, but if you don't know this formula by now, something's gone wrong in your prior classes. You've probably seen this formula 3 or 4 times in different classes. So it's the most used formula in finance. So you should have this one down just pat without even thinking about it. So the question is come up with the numbers. So the risk-free rate, all you got to do there is just look and see what she says. Your boss is using the forward curve for her risk-free rate, where the current 10-year forward yield is 2.6. So there it is right there, 2.6%. I would recommend, I've had a few students that can't handle percentage signs, so I'd recommend you just type everything in decimals. I have this problem more with my graduate students that they'll, instead of typing in 2.6%, they'll type 260% and not understand why they're getting a stock price of like 37 cents. So if you have any struggles with that, just on the exam, do everything in decimals. Then we got to get the market risk premium. The market risk premium is going to equal the required return on stocks minus the risk-free rate. We're going to say that the required return on stocks equals the expected return on stocks. We're using the implied approach. The expected return on stocks equals the current dividend yield plus expected earnings growth. And maybe, and sometimes I do like to put in the buyback yield. I think she does that here. If I give it to you, then put that in there. So the current yield, on stocks, she calculates expected GDP growth as sum of productivity. So the expected earnings growth, we'll put that in first. So expected earnings growth will equal expected GDP growth, which equals, well, she actually even in this case gives you the number. They just happen to be the same. But she says nominal corporate earnings growth of 4.5%. So she's giving you that number, so you don't have to calculate it. It does happen to come out to be 4.5%, so it does equal. But if she gives you the number, just use the number. So the key here is that we're looking for expected nominal corporate earnings growth. So if she gives you that number, use it. If not, she says it's going to be the same as the economy, then add those 3 numbers together. So some students really struggle here because it changes, but that's the way the world is. Some people do it like this, some people like to do this. So you read the question and you got to figure out what it's saying. It shouldn't be that difficult, although a few students just really bombed on this last semester. I think they just panic because it's not the exact same question every time. And it's like, boy, in finance, it's never the exact same question every time. So you've got to somehow figure out how to think on your feet. So the dividend yield for stocks is 2%. Now she said Toll's dividend yield is 1.1, but that has absolutely nothing to do with the expected return on stocks. We're not talking about the expected return on Toll, we're talking about the expected return on the stock market. So we don't care about this number at all. It's completely superfluous. Adjusted buyback, she's going to add that in, so 1.5%. Toll's buyback yield, we don't care about that. We're not talking about Toll. The only time we worry about Toll here is the beta. That's the only place Toll comes in. Everywhere else, it's the market numbers. And then expected earnings growth, she gives that to you right there, 4.5%. So you put all that together, and you get an expected return on stocks of 8%. So it gives you a market risk premium of 8% minus 2.6%. So you get a market risk premium of 5.4%. And then for your beta, remember you have to have 4 steps here. You got to talk about the type of company that it is. Its revenue sensitivity. So this is obviously a cyclical company. They build houses. So that's definitely going to be a high beta, above beta 1 company. So how far above 1, we'll see, but they build houses. Sorry, I'm having to let into the room at the same talking. So, all right, so definitely a cyclical company. The second thing is their operating leverage. So here we can look down at the standard deviation of their margins, their net margins, and it's 12.53%. So the standard deviation of net margins is 12.53%, well above that of the stock market. So operating leverage must be above average, which pushes beta up above 1 as well. So we're above. So here we have, so beta above 1 because it's a cyclical company. Volatile net interest margins, which implies high operating leverage. So that gives you a beta above 1. Your financial leverage, you can see that their debt to equity is 77.55%. So slightly above average versus the market. So keeps beta above 1. Doesn't have that much impact in other ones. And then the last one is just the history. We look down at the history. And we see that their median beta is around 1.5. Recently, it's been much lower. It's even been below 1, which is kind of bizarre. And that's mainly because the housing market's doing really well, even as the economy was starting to slow down some. But that's noise. We don't want to look at the recent number. So look at the long-term number. I think 1.5 history implies beta around 1.5. 1.5 is consistent with 1 through 3, so I will use 1.5. So the discount rate, KE, is 0.026 plus 1.5 times 0.054, R 0.107. All right, so there's your answer to that first one. Any questions on that?
Professor, can we use beta 1.4?
Say it louder, Samurai, I can barely hear you.
Can we use beta 1.4?
So you're asking about 1.4? I'm sorry, again, my volume is not working here.
Yeah, can we use beta 1.4 instead of 1.5?
Oh, this is not the right answer. So it could be 1.2, it could be 1.3, 1.5, 1.6, 1.7. I wouldn't count out for any of that. Anything that seems reasonable. If you use the beta of 0.6, I would probably count off for that. But yeah, no, there's more than one answer here. I actually have the whole problem set up, so all I have to do is key in whatever beta you use, and I can check your answer pretty quickly. It feeds for everything else. So yeah, good question. That's the only thing in this entire problem where you might have a different answer. but everywhere else the numbers are given, so there isn't any flexibility. So yeah, good question. You come up with your own beta, whatever makes sense to you. Then we get into valuation. So for valuation, we have our KE is 10.7%, our dividend 0. Last 12 months is $1.90. Our EPS 0 is 470. That's given up there. Long-term growth for toll is 4.5%. Be careful on this. This just happens to be the same as what I used in question 1, but it doesn't always have to be. Short-term growth, you can see that right here, 12%. So 0.12, and then the H, you can see that right here, next 8 years. So your H is 8 divided by 2, or 4. All right, so there's all your inputs. And so all you got to do is just plug it into the model, the dividend discount model. You'll take dividend 0 times 1 plus long-term growth divided by KE minus long-term growth. I don't count off for simple math errors. However, you know automatically if your KE is less than your long-term growth, you know you did something wrong. So in that case, I do count off for math errors where you should know it's a math error. If you get in that point where you have a math error, you know it's a math error, but you can't figure it out, then at least make a note. I know there's something wrong. This number be higher than this, and at least I can give you a lot more partial credit. So 1.90 times 1 plus 0.045 divided by 0.107 minus 0.045, and you get a price of 32.02. And several of y'all got that correct last week. Your number may be slightly different, but just change your calculation to 1.5 beta, and you'll get it. The cap earnings, you're going to do EPS 0 times, oh, the one thing I left out of here is inflation. Inflation equals 1.9%. So for this one, we use EPS zeros times 1 plus inflation divided by KE minus inflation. So in this case, we'll use 4.70 times 1 plus 0.019 divided by 0.107 minus 0.019. That equals 54.42. And then the last one is the H model. It's the same as the dividend discount model, but with an one added section here in the middle. So plus dividend 0 times H times short-term growth minus long-term growth. So that gives us 1.9 times 1 plus 0.045 plus 1.9 times 4 times 0.12 minus 0.045. All that divided by that. And that gives you 41.22. And you can check the difference. The H model minus the dividend discount model equals 41.22 minus 33.02. Or that's, oh man, it's my roundings off here. 19.20. And you can just check that by taking this added section right here and calculating that, and that should give you the difference. So you just take 1.90 times 4 times 0.12 minus 0.045 divided by 0.107 minus 0.045, and that should equal about 1920. I have some rounding here, so it might be off of pennies, but it's probably pretty close. Let me check just real quick because I don't want to throw you all up. So 1.9 times 4 times 0.12 minus 0.045 divided by 0.107 minus, Bill Gates, minus 0.045 divided by 107 minus 0.045. And it's 1919. I mean, there's just some rounding going in here. I'm not sure what the rounding issue is here because it must be just barely off a penny there. But so 1919, 1920, but there's some rounding in one of these two numbers that just happens to take us exactly to a penny. So as long as you're within a penny, you should be fine. So there's your answers here. 3202, 5442, and make sure you show all of your work on the exam. If you do not show your work on the exam, I give 0 credit for math errors because I don't know what math error you did. So write out the formulas, put everything into the formula. I mean, it's all there. Just make sure you write it all out so you don't have an error. Some students get off by decimal places here, use 45% instead of 4.5%. I'll definitely count off for that, but you get some partial credit. If you just give me a number that doesn't make any sense, and I don't know how you calculate it, there's no way I can give you partial credit. All right. So there's that problem. Any questions on that? Most students last semester, probably 70% of students got 100% on those two problems, or somewhere close. Just 60, 70%. He's got in the 90s to 100. A lot of students got 100% on those questions because they really are just plug and play. The only thing that you know about is to make sure you put these 4 steps on your exam. I need all 4 of these steps on your exam. The type of company, operating leverage, financial leverage, the history, make sure all of those are there. All right, no questions? Y'all got it?
Yeah.
Yeah.
Diego here. So are we going to get a problem exactly like this one on the test? Or?
It'll look very close. It's possible this paragraph where she says what her belief is. It's possible it'd be a little different here. You just have to read it and see what it says. So this time she's doing the forward treasury. She might use the actual treasury rate. She might not put the buyback yield in there. She's just got to look and see. Her view of the economy might be different than her view of the stock market. She might think the economy is going to grow 4%, but the stock market is going to grow 4.5%. So I was just going to make sure you know that the number you're using is not economic growth, it's actual corporate earnings growth. We're using economic growth as a proxy, but if she tells you what she thinks corporate earnings growth is going to be, then do that. You can see here it's in line with the overall economy, so they're the same, but they don't have to be the same. Remember, historically, the economy's grown about 0.5% faster than corporate earnings have. So she might say, hey, I think the economy is going to grow 4.5%, but I think corporate earnings will be 0.5 below that. So whatever she says, this is really a question if you can read the paragraph and just understand what she's saying. And that you understand the formulas and know what to look for. I do throw things like this in, Toll's dividend, Toll's buyback, which has nothing to do with this first part of the problem. You don't need that data anywhere, but just to make sure you understand these formulas and what you're looking for. So it's possible I'll put something in there just to see if you've been paying attention and understand these theories, or if you've just been plugging in. So there's always that critical thinking part of this. Okay. If you make an error on this first part and it causes you to get a discount rate of like 9%, that doesn't harm you on question 2. So on question 2, if you get 9%, I'll just plug 9% in on my computer. And if you get the right prices with the wrong discount rate, then you'll get 100% credit on this problem, but lose points on question 1. So it doesn't, your errors don't accumulate over and over and over again, every question. And plus, because of the way we're going to have to do this on Blackboard, I may actually give you a discount rate for question 2 to use. So that'll actually make it a little easier for me to grade question 2. So then everyone will get the exact same answer. All right, other questions? Good question, Diego. What else?
Oh, I have like one more question. So for the beta, we need to, I guess, if it's cyclical, it's going to be above 1, and we need to like sort of guess what beta we're going to use.
Right. Now, if you think a company's defensive when I think it's cyclical, I don't count out for that as long as your rationale is clear. There are some companies that are kind of hard. I usually pick companies that it's pretty obvious. Like if I gave you Kroger's, what would that be?
That would be a that would be a defensive.
Defensive.
Data.
So well below one, right? If I gave you Ford Motor Company.
That would be a
Cyclical.
Yeah, so I usually make them pretty obvious, but if it's not obvious to you, put your rationale on why you think that's the case. Now, obviously, the historical chart's gonna, if you're thinking something's defensive and you see the median's well above one, then you might go back and rethink what you said on the revenue side. All right, because I'm definitely not going to give you an obvious cyclical company and then you give you a beta chart where the beta is well below one and make it confusing. I'm not trying to confuse y'all on exam. So I pick companies where it's pretty, I think, pretty straightforward. It's possible someone disagrees with me, and that's the case. You know, I'll take that in consideration. As long as you're logical. I'm looking more at your logic, not that we all agree exactly the same way about these companies. In companies like Target and McDonald's, even firms like Caterpillar and Deere, you can, Caterpillar and Deere, they build heavy equipment. That sounds like a beta above one, but a big part of their business is agriculture, but also a big part of business construction. I would think of Caterpillar and Deere as well above one, but someone might say, well, they do a lot of stuff for agriculture and that's a low beta. So as long as you're logical, I'll give you full credit. Other questions on this? This is a really great question.
Professor Sweet, you said
papers 3 and 4 give you practice. Devin?
You said that if they might not give us the buyback yield, are we just going to go with the 1.5% for the Ibbotson article? If we just reference that, is that okay?
Well, no, if I don't give you the buyback yield, you don't use it. If your boss doesn't add the buyback yield in, don't add it back in. So your boss is telling you exactly what she does. So you don't, if she doesn't tell you about the buyback yield, don't add it back in.
Okay.
I mean, you can go sit down with her and try to talk her into it, but you're not gonna have time to do that during the exam. So she wins. This is what she does. This is an entry level job, right? You have to take what the portfolio manager says, and then 5 years later you can set the rules. So now on paper 3 and 4, you get to set all the rules. You're the portfolio manager. You get to decide on that paper. But you see how much this looks like paper 3 and 4, doesn't it? The difference is you've got to come up with all these numbers, what makes that so important. That's one thing I hate about undergraduate is so many classes, we give you all this stuff, which is the hard stuff, and then we ask you to calculate the easy stuff, which is plug it into a formula. In reality, we don't give you anything. You got to come up with all of it. So that's why papers 3 and 4 is so critically important, that you really understand. Boy, it's up to you to come up with these numbers and figure out what they mean. All right, so there's that problem. Let me show you the problem I want you to do for, let's see, why is Zoom not, there it is, okay. This is one, I think it's next Tuesday's, I'm pretty sure it's next Tuesday's class. So if you want to look ahead on Tuesday's class and send this in to me early, so you don't have to worry about the week of Thanksgiving, that's fine, or just watch it on Tuesday and send it to me by Thursday. So I'll take them through Thursday. You can take a picture of this because I don't want to email it out. So your boss wants to assess the correct relative value factor to use for toll. So you have two things here. Make sure you see there's two things here. Which price relative would be appropriate? And that includes two things. Why is it appropriate for toll? There's some of these that are not appropriate for any company. All right. So I'll give you a hint. There's 1, 2, 3, 4, 5, 6 of them. And one of them is one you would throw out for any company. It doesn't make sense. Don't tell me what that is. I want you to answer it yourself. The other 5 are good. They're perfectly fine ratios, but which one's most appropriate for toll? All right. So you'll get a question like this on the exam. You haven't seen it yet. You'll see it on next Tuesday's class unless you're looking ahead. That class walks you through that. So no, I think actually you have seen it already. Yeah, you've already seen this. So you can, yeah, I'll still give you a few days on this. If you get it to me, I'll give you credit. But yeah, I'm getting my options and derivatives mixed up with my relative value. So we've definitely already done relative value. You did it this week with the YouTubes. But yeah, so I'm not, given Thanksgiving, you get it to me in the next several days, I'll be fine. I'll give you credit. This is a question, this actually is probably the most missed question on the exam. And it amazes me because in my mind, it seems really simple. So there's obviously something wrong with the way I'm explaining it that I'm not somehow connecting. I think part of it, students are just not engaged when they're listening to it, and then the exam comes around and it's like the first time they've ever seen it. So really listen, this is pretty critically important stuff that you understand, especially for interviews. All right, everybody's got it? Y'all see that question? All right.
So I have a question, sir. So the one that we choose from this list, do we need to like go to the historical data and calculate it, or do we just need to give the?
Oh, there's no numbers here. You just which ratio is most appropriate for the firm you're looking at. There's no calculation, there's no history, there's nothing. All you do here is say, is the PEG ratio the best? Is price to earnings the best? Is price to book? Enterprise value to EBITDA, enterprise value to revenue, the earnings. One of them is just wrong, so you got to tell me one of them is wrong and why. The other 5 are right ratios, but there's only one, and I'll tell you, there's only one that makes sense for toll as their main ratio. I mean, there's some that work for any company, but toll has one of these 6 is absolutely the most appropriate one. If you're in an interview with Toll Brothers and you're talking about their company, if you start talking about the wrong price relative, they'd be looking at you funny. You should know which of these 6 you should be talking about. So if you go in the company and says, yeah, I've noticed that you're this relative, and you say that whichever one has been trending up here recently. Some might argue your stock looks a little expensive. That would make sense. You pick the wrong one. They say, well, why are they talking about that ratio? That doesn't make sense for our industry. So you want to line it up with the correct industry. All right, read back through the notes, watch the videos, make sure you're clear on that. It's a really quite critically important question because it's something we do a lot in finance. So if you're not clear on it, you're going to get embarrassed in an interview. So really hunker down on it and read it over and over again until it becomes clear. Hopefully this class will break trend and actually do better on this question than previous classes. All right, anything else on this one? Any questions on papers 3 and 4? I'm letting y'all do it on your own. You have that entire video that walks through papers 3 and 4. So you can just watch it, hit pause, go get your numbers, go to the next stop. That's the way I would recommend you do it, is actually write your paper. Make sure you write a paper though. Don't give me bullets. Give me an actual paper. It should look just as professional as what you are doing on papers 1 and 2. The 2 columns and good graphs, narrow margins, will justify some charts and graphs, and put the beta chart in there. Give me a description. Well, I still have some students that are turning in papers with absolutely no introduction at all. They just start talking about the company without even saying who the company is. So put something about who is your company, what do they do. And that what you're going to do in this paper. In this paper, I'm going to come up with the discount rate for my company and then value them. Make it a professional looking paper. Tell us what you're going to do, then do it, then tell us what you did, and have a final conclusion. Make sure your final conclusion, you're comparing your valuations to the actual stock price. I have some students who write the whole paper and never put the actual stock price in the paper. And I don't care which day you pick the stock price. Obviously, you write the paper on Wednesday, and by Thursday, the stock has fallen 2 or 3%. You don't need to change it. Just stick with whatever you picked at the time you finished the paper. Because again, we're not doing a Zoom on papers 3 and 4, and I'm a little worried about it because I always have some students that completely miss it. If you're on edge on your grade in this class and you don't send me papers 3 and 4 in advance and talk about it, I won't understand that at all. Someone's like, I'm barely passing this class, but I never hear from them to make sure their paper's in line with what we're looking for, then that's kind of their own fault. So make sure you don't take that risk. Once you turn it in, once the date comes in, there's nothing, especially this time of the semester, I have students saying, hey, I'm graduating, what can you give me as extra credit? There's nothing I can do. Once that final, especially once the final exam comes in, once papers 3 and 4 come in, there's nothing I can do, because anything I offer one student, I have to offer to all 60 students. And there is no way I'm about to offer something to all 60 students when I have 300 things to grade in 2 weeks. So just take that in light. If you ask me in advance and call me and talk to me, yeah, that's exactly what you do. After the due date, there's nothing I can do. All right, nothing on papers 3 and 4. Any questions on the class materials? You saw the relative value analysis. So the only thing we have left is my favorite topic, which is derivatives. So I'm covering those the next 3 classes. I'm then going to put last semester's exam 2 onto Blackboard. And I will sometime do a video where I'll work that entire exam. What I recommend that you do is work that entire exam, practicing for exam 2, and then watch the video. Don't watch the video and then work the exam, and then watch the video to make sure you're ready to go. It's going to be a very timed exam. It'll be open book, but it's going to be very timed. So you're going to have very limited on time. So you can't just assume, well, it's open book, I don't need to study for exam 2, because if you don't study, you will not get the questions done in time. And you'll be losing 100% of points because you turned in the question late. So study for this exam as if it were not open book. And plus, there's absolutely nothing on this exam you shouldn't know off the top of your head. So if you're interviewing for jobs, everything on this exam you should know off the top of your head. So if you're having to look it up, then you missed something. So you're in bad shape. You're behind. So don't let that happen. Learn everything on this exam. Make sure you know it. You should have had most of the stuff in 3013 as well. So it's just rehash. So you just forget about looking stuff up in textbooks. Put it into your permanent memory. And make sure you're ready for it. All right. Any final questions? I want to kind of keep this to 30 minutes.
Professor, will we have a essay question for exam 2?
I'm not doing an essay question this semester. Usually the essay question I do is on beta, but because you're going to have to cover that in paper 3 anyway, I'm just going to look to paper 3 to see if you understand beta. So rather than double counting it on the exam and on paper 3, I'll just see. So make sure your paper 3 discussion on beta is good, that you fully understand it. Anything else? So we won't have a Zoom class next week. We probably will have one the last week and have a last participation. The last thing is on participation is, so we only have one more participation we'll do after this one that we're doing today. And then your last participation is sending me your notes for the class, what you've done to keep track of the class, what notes you've taken. I don't know what form that's going to be. It might be a mess, but we'll see. If you do your notes by hand, then you may have to photocopy a sampling of your notes and send them. We'll see. We'll figure that out in the last class. You'll have a few days to put that together. So that'll be it for participation, and I'll somehow get you what your participation score is by the time of the final. All right, that's it. Hope everybody has a good Thanksgiving, and I'll see y'all. We'll do a Zoom the very last week of class. It's hard to believe it's almost over with 2020. No other questions? I'll stay on if anyone has questions. We're done at this point. I'll put this out on our YouTube channel, so you can, if you miss something, you can catch up on it.
Thank you, Professor.
So,
Right.
Professor.
Huh?
You go ahead, sir.
Gracias, profesor.
De nada. Hasta luego.
Professor Sweet.
Yes.
So I was going to ask you, how many questions are there going to be on the exam? It's the first, the first like participation thing that we did.
Well, you've seen every question but the option one, so you've seen all of them. So the first question is what we just did today. It's coming up with the discount rate for your company. Valuing the stocks is the second question. The third question is valuing the bonds. Y'all did that a few weeks ago. The fourth question is the returns. Remember that? Holding period return and annualized geometric and arithmetic return. The fifth one is the one we just did today in relative value. that you're gonna turn in after this, and then you have an option question. So I think it's 6 questions. I can look real quickly, but I think it's 6 questions. 2, 3, 4, 5, yeah, 6 questions. There were 2 essay questions I've done in the past. I'll take them off of the exam I send y'all. One essay question had to do with the inputs for options. That one's just way too easy for you to put in an exam because you can just look it up and write it down. So it's kind of a waste of time to ask it. So yeah, it'll be 6 questions, no essays, all math problems, with the exception of one we did today, right? The relative value is just, it's an essay question, but it's kind of a multiple choice with an explanation kind of question.
Okay. And then how much time are we going to have? Like, it's said by the UTSA final?
Well, you have the whole final time, but you'll be limited by questions. So the way I do it is I send out a question one at a time. And a question, you might have 20 minutes to get the question done. So you better be ready to go. That's why I say you better study in advance. So I don't send you all the questions. You have to work one at a time. And you'll be limited. So let's say I might give you, let's say I give you 25 minutes on a question. So I'll send it out at say 1 o'clock or whenever the exam is. I'll send out question 2 at 1:25, right when the other questions due. And so I'll just keep doing that. I'll probably have multiple versions so that, you know, it depends on which version you get. So you might have a different answer than someone else. I might change some of the numbers up just in case students think they want to share notes or whatever. You'll have different answers. And so if 2 students give me the same answer for different questions, that's certainly going to be a concern. But yeah, you'll have a set amount of time, and you got to do it by that set amount of time. So if you're not done, you turn in what you have, and if you're late, then you don't get credit for that question. Some students say that's really stressful, and it is. But if you know the material, it shouldn't be. You should know it all. I'll let you know what that time is when I give you the example question, so you can practice and make sure you can do it in that time. Anything else?
Professor Sweet, do you remember the company that I was mentioning to you that I was doing for paper 3?
I can't remember. No.
Okay. I'll email you about it. I was going to ask you, I got a discount rate that I thought might be a little bit high. I think it's okay, but I'll email you about it.
Well, if you don't want to, someone emailed me on that. I emailed back that it was okay. I can't remember if that was you or somebody else, but someone.
I did email you about the beta. You said my betas looked pretty good. I revised the financial leverage one down a little bit. I put it to like 1.7, but I knocked it back to 1.65, and I ended up using the 1.5 for my beta.
Yeah, I mean, most students cheat a little bit and they value their stock, and if it's way off of the current price, they go back and start changing things. I don't really like that approach. I mean, if you think it's worth $30 and it's trading for 70, then put down 30. I prefer that approach. I can tell some students go back and wiggle the numbers around until they get something like $64 or something. I don't like that approach at all. You should put the assumptions down, value the stock, and at the very last second, look at what the stock's actually trading for, and then write that in. Don't go back. And there's probably 20-25% of students who always go back and try to match the current stock price, and that's just not a good way to do stock valuation.
Okay. Yeah. Okay. I'll just send you an email with like what I have so far, and
Okay.
if that looks good to you. I think it's pretty good.
Okay.
Thank you. I appreciate it.
Sure. All right. See you later. Thanks, everybody. I'm going to click off. Bye.
Thank you. Bye.